Hello everyone, I hope you guys are doing well and studies going in full swing. In today's video, we would be covering the second part of valuation pertaining to equities, convertibles, right shares, money market instruments and a lot more. After our first video on valuation of bonds, so in case you are looking for bonds, you can take the earlier video. We will share the link in the description box as well. And in case you want to look at the second section of equity, which is equities and everything else, this is where we kind of cover that. All concepts and important questions from our Super 90 file. So let us get started. So when we look at valuation of equity shares, how do you value equity share or rather any asset in the world of finance? It is based on the present value of future cash flows. Now even bonds were valued as present value of future cash flows, but the problem over here is bonds have a specified life frame and hence the present value of future interest as well as the redemption values will give you the total value of the bond. However, when it comes to equity shares, in equity shares it continues up to perpetuity. Again, interest is generally fixed, dividend can keep on changing and hence there may be certain challenges in valuing equity shares. So Gordon tries to address these challenges and tries to devise a formula whereby you can value an equity share considering the present value of all future dividends, and the formula goes something like this: P0 is equal to D1, P0 is the price today, D1 is the expected dividend in the upcoming year upon KE, that is the cost of equity, minus G, that is the growth rate. Now the derivation of formula is not really important from an exam perspective. We would have done this in a regular session. However, just for a concept level understanding, this small formula that you see takes the present value of all the future dividends up to perpetuity, assuming they are growing at a constant rate, that is G. And since this is a formula which is applicable to perpetual cash flows, here the perpetual cash flow is dividend. Tomorrow the cash flow may be free cash flow. Next day it may be synergies. Well, for different topics there might be different applications, but whenever you see a cash flow that continues up to perpetuity, well, this is a formula that you fall back on for finding the value, present value of all the future cash flows. Now how do you figure out each of these cash flows? Well, D1 is the dividend for year 1. If it is dividend paid, it is D0. If it is expected dividend, it is D1. However, if it is current dividend, I don't really know whether it's D1 or D0, and a lot of cases in the institute they have not been consistent over here. So what we suggest is you can write down that in absence of information we assume that the given dividend is D0, alternatively can also be assumed as D1, and you solve it accordingly. So over here that is your D1. If D0 is given, let us say 10 rupees and the growth rate is 5%, 10 rupees plus 5%, that is 10.5 will be D1. If a D1 is directly given, you can take it as it is. Then you come to KE. KE is the cost of equity, and the cost of equity over here can be calculated in various ways. The best way to calculate KE is usually the CAPM, capital asset pricing model, that is RF plus RM minus RF into beta. You would do a PhD on this when you go to the chapter on portfolio management. But what if data regarding RF, RM, beta is not available? In such a case, you will go to the next best formula, which is typically the Gordon's formula, which is D1 by P0 plus G, depending on the data available. However, this is the next best formula. The best formula is CAPM because it links the required return to the risk. So it links the KE to the beta, whereas Gordon's formula is just a rearrangement of this core formula that Gordon kind of derived. If data regarding growth etc. is also not available, then you go to the earnings yield formula, that is earnings divided by price. And if data regarding earnings is also not available, then you can directly take the dividend yield formula, which people say is the worst formula, D1 by P0. So these are 4 methods to calculate KE, the best being CAPM, followed by Gordon's formula, followed by earnings yield method, which is also sometimes restated as the inverse of the PE ratio, and D1 by P0 into 100. So these are the methods to calculate KE. Okay, so you can find the D1, can find the KE. Next comes G. G is equal to R into B, where R is the rate of return that you earn on retained earnings, and if that is not available, you can directly take it as the rate of equity, ROE, into B. B is the retention ratio, which is usually 1 minus the payout ratio. So if 100 rupees is your total earnings, out of which 40 is distributed, that means 60 is retained. So 1 minus the payout ratio will be the retention ratio. ROE or R can be calculated as profit available for equity shareholders divided by equity shareholders funds, that is share capital plus reserves, and that will give you your return on equity. So this will give you the price of a share in case of a single stage growth, that is the growth grows at a constant rate in each year up to perpetuity. Now as you would be aware, that is very difficult to achieve. To have a constant growth of 5% up to perpetuity is very unlikely, and hence you need to modify this formula. One of the most common ways in which this formula will possibly be tested is a multi-stage dividend growth model. But before going over there, just a couple of things that you need to remember. looking at the formula, just remember G and P0 are directly related. So as the growth increases, your P0, that is d1 by Ke minus G, as G increases, the denominator will fall and hence the price increases. Whereas Ke and P0 are inversely related. Ke is a cost item and hence if the cost increases, the denominator of the equation falls and hence the P0 falls. So over here, if the denominator rises, if Ke rises, then the price will fall. So generally, if you understand it well and good, otherwise just remember intuitively, higher the growth, higher should be the price. Perfect. Higher the cost, lower should be the price. So higher the Ke, lower will be the price. There's an inverse relationship. Okay. Next you have what is more important from an exam perspective in my understanding, which is a multi-stage growth model. What we have studied till now is taking d1 by Ke minus G. This formula will only work, among other things, if your growth is constant from year 1 all the way up to perpetuity. However, if you look at a particular company, you can actually try to predict the cash flows for the next 3 or maybe 5 years. After that, future becomes very blurry and you are unable to predict, but at least for the next 3, 4, 5 years, you are able to forecast what will happen, what will be the revenue growth, what will be the expenses, etc. In which case, you might try to find different growth rates in, let us say, the foreseeable forecasting period, and after that the growth rate, let us say, stabilizes, in which case what will you have to do? Well, you will probably break this formula, which is P0, which is the PV of D1 by D2 plus D3, let's say for 3 years. The growth is different. After that, PV of D4 plus D5 all the way up to perpetuity. Now, for the first 3 years, you will try to predict the future dividends and you will take the present value for the same like you do for bonds. And then from year 4 all the way up to perpetuity, you will use the terminal value calculation. So over here, what one needs to remember? Well, over here the price of a share is the present value of all future dividends. So the first 3 dividends you have taken, and then you take D4 by Ke minus G. D4 was not taken in the first 3 dividends. It is from D4 onwards the growth is stabilizing, D4 by Ke minus G. But D4 by Ke minus G gives you what? Sir, P3, like P0 is equal to D1 by Ke minus G. P3 is equal to D4 by Ke minus G. Sir, how does it matter? Well, because we are trying to find the value today. So this will give you, let's say, the present value of the first 3 years of dividend plus something called as a terminal value, that is a value that you can possibly expect to get if theoretically you were looking to sell the share at the end of the 3rd year. What is the price you will get at the end of the 3rd year? Well, it will be based on the dividends of year 4, 5, 6 all the way up to perpetuity, and as a result over here this will give you P3, but you want to find P0 and hence you will have to find the present value. While doing so, 2 things that students miss out. First, they forget doing the present value. Second, if they do the present value, they say they see D4 and they take the 4th as discount rate. No, you should not be doing that. Well, even if it is D4, D4 by Ke minus G actually gives you P3, and hence you will take the discount factor, let us say, for the 3rd year. You will take the discount factor for the 3rd year. Why? Because this is P3, and hence this is theoretically the price that you get if you were to theoretically sell the share at the end of the 3rd year, and hence this is the price you will possibly get at the end of the 3rd year. So these are the 2 or 3 things that you have to remember, at least for equity. Then there is free cash flow valuation, but before we do free cash flow valuation, I want you to probably try a sum or sum on this so that you get a better understanding. So the first 6 sums were on bonds. Next, question number 7, you will go into equities. This is an interesting question. Let's review this. Sewell Corporation reported an earnings per share of 2.1 in 2003, reported, which means this must be E0, and it paid a dividend per share of 0.69 paid, and hence this must be D0. On 1st January 2004, an analyst expects the earnings to grow at the rate of 15% from the year 2004, maybe this is calendar year 4, 5, 6, 7, 8 for 5 years. Also during the period, the dividend payout ratio is expected to remain unchanged. Now what is the dividend payout ratio? 0.69, which was the dividend, divided by 2.1, which is the earnings. This is around 32 point something, which will be the dividend payout ratio, 32.86, let us say. This is expected to remain constant as given in the question. Okay, and the earnings are likely to grow at the rate of 15%. All of this data will help me predict the dividend of the upcoming 5 years. After 2008, the earnings growth rate is expected to drop to a stable rate of 6%, and the payout ratio is expected to increase to 65% of the earnings. Okay, so that is after 2008, that is from 2009 onwards. The firm has a beta of 1.4 currently and is expected to have a beta of 1.1 after 2008. Very interesting. Even betas are different, and if betas are different, Ks will also be different. The market risk premium, that is RM minus RF, is 5.5%, and the treasury bond, that is the risk free rate, RF, is 6.25. Okay, so you can calculate KE using CAPM. What is the expected price of the share at the end of 2008? You are currently in 2004, so this is like P5 being asked. And what is the value of the share today? That is 1st January 2004 using a two-stage dividend discount model. So P0 is asked. So the value of a share is the present value of all the future cash flows. And if you have to find the future cash flows, you need to find the dividends for the year 2004, 5, 6, 7 and 8. So for that you have earnings which are growing at the rate of 15%. So 2.1 plus 15% will come to, let's say, 2.42, plus another 15% will come to, let's say, 2.78, and so on. And the dividends over here, you will have a payout ratio of 32.86%, which is said to be same. So 2.42 into 32.86% will come to around 0.795 or 0.8. Again, 2.78 into 32.86% will come to, let us say, 2.79 into 32.86% comes to around 0.92, let us say, and so on. You will predict the dividends for the 5 years. Okay, after you do that, let us say if I were to look at 2.78 plus 15, so I can just look at the data which is given. For example, 2.42, 2.78, 0.80, 0.91 or 92 as a guess. Maybe then you will do the same working, increase by 15%, increase by 15%, and you will reach 2008. This is the situation in 2008. Now comes the slight problem. From 2008 onwards, the question tells you that the growth is going to stabilize, if I am not wrong, to a rate of 6%. So I will say that what will be my earnings for the next year? Well, if it is 4.23 for the year 2008, then 4.23 plus 6% will come to 4.48. Okay, that will be my earnings, but my valuation is based on the cash flow, which is dividend. So 4.48 into, for example, 65%, which is a revised payout ratio. So this is going to be, let us say, 2.91 will be my dividend. So my dividend will be 2.91. Usually we take the dividend directly as D5 plus the growth rate. But here the payout ratio is changing, and hence you have to find the earnings at a 6% growth rate, and on that apply a 65% payout ratio. This will give you 2.91. So over here the valuation of a share is the present value of the future dividends, that is the first 5 years of dividend, which comes to, if I do this working, okay, for finding the present value you will have to calculate KE. Now the problem over here is KE from 2004 to 2008 will be RF plus RM minus RF into beta, that is 6.25 plus 5.5 directly, because this is market risk premium, into 1.4. The moment you go to the year 2009 onwards, or that is from 2008, this will be 6.25 plus 5.5, but the beta falls to, I think, 1.1, and hence 5.5 into 1.4 plus 6.25 came to around 13.95, and then 5.5 into 1.1 plus 6.25 comes to around 12.3. Now the problem is, what is the discounting factor you are going to use? You ask yourself that when you are receiving a cash flow in the first year, that is in the year 2004, what is the required rate of returns at 13.95? In the second year, again, the required rate of return is 13.95, and hence all of these dividends will be discounted at the rate of 13.95%, because the required rate of return between 2004 all the way up to 2008 was 13.95%. Now comes the problem. If you do the terminal value calculation will be basically dividend of 2009. Basically that is like the 6th year, D6, divided by KE minus G. This will give you price at the end of 2008. So basically if I look at D6 will equal to P5 by KE minus G. Now D6 we have calculated is around 2.91. KE over here should be taken as what? Well, growth we know is 0.06. What should be the KE that you should take over here? Think and tell me. Okay, over here we will tell ourselves that this is the present value of dividends of 6, 7, 8, 9, 10 in the year 2009, 10, 11, 12, 13, 14. What was the required rate of return in all of these time frames? Sir, 12.3%. So this is 0.123, and hence 2.91 divided by, let's say, 0.063 will come to around 46.19. This will come to rupees 46.19, and hence if this is 46.19, this 46.19 is going to give you, let us say, your price. But this is P5. Well, one of the questions asks me that what is the price at the end of the 5th year, that is 2008, it should be 46.19. But think of it this way, if I were to hold the share for 5 years and then sell it after 5 years, I am expecting to get 46.19, but that is 46.19 after 5 years. I want to find the value today. So if I were to discount 46.19 at today's value, I will have to discount it by a further 5 years. So into the present value factor at some rate for the 5th year. Now the problem is, which rate will I take? Will I take 13.95% or 12.3%? Well, what is the objective of this discounting? This discounting will take you from 2008 up to 2004. It will take you from 2008 value, that is 46.1, to a 2004 value. Tell me, what is the rate prevailing then? So 13.95%. And as a result, the discounting of this 46.19 will be at the rate of 13.95%. So these two things are important. Said that when you are discounting, what is the rate that we are taking? Sir, we are taking 13.95 because this is in the first, second, third, fourth, fifth year when the required rate of return was 13.95. Acha, from the 6th year onwards, I am happy receiving even 12.3%. So the dividends of the year 6, 7, 8, 9 all the way up to perpetuity were discounted and they were brought to the present value at the rate of 12.3%. But once they are on 31st December 2008, you still need to bring them to 1st January 2004, for which you will take 13.95% over here. This is important, and a 12.3%, let us say, over here. So this is something which is, I would say, slightly important. Multi-stage growth, where there are different growth rates and different KEs as well. Now another type of a question is where they will directly give you what is the price that is expected, let us say, after X years. However, there may be some adjustment like bonus which might come. So how will you take that into consideration? We will look at question number 8. A share with a par value, that is a face value of 100 rupees, has a current market price of 500. This is given. Annual dividend is 20% unless given otherwise. Dividend is a percentage of face value. So 100 rupees is the face value into 20%, maybe 20 rupees is the dividend. This is an important challenge. Bonus shares are expected to be issued in the 5th year for one share, that is at one share for 4 shares held. So if you are holding 100 shares, 100 into 1 by 4, you will get 25 shares. Or if you are holding one share, assuming fractional shares are possible, you get 1 into 1 by 4, that is equal to 0.25 shares. One shareholder intends to sell these shares at the end of the 8th year. So you want to hold it for 8 years, receive 8 years of dividend, and then want to sell it at the end of 8 years. Typically, you would have found this as D9 by KE minus G. P8. Price of the share is expected to be 900 at the end of the 8th year. If this is given to us, I don't need to separately go out and find a P8. We will directly take 900. Shareholders are required to bear incidental expenses on sale and purchase of the shares at the rate of 10% of the market price of the share. Dividend rate will remain the same. Rate, not amount, will remain the same even after the bonus issue. Here, but will bonus impact my dividend? Well, yes, because one share pre-bonus will become 1.25 shares post-bonus. And hence, if I was receiving dividend of one share into rupees 100 into 20%, I will now receive dividend of 1.25 shares into rupees 100 into 20%. Similarly, when I sell after 8 years, I will say that if I sell one share, I will get 900 rupees. Yes, but the one share that you acquire today will ultimately become 1.25 shares, and that is something that you have to be careful about. Your required rate of return is 10%. Ignore taxation should the share be purchased, and if yes, at what maximum price. So if I look at question number 8 over here, I will look at what is the value of my share. Value of my share is the present value of all the future cash flows. Cash flows over here will include the dividends. So the dividends in the first 4 years before the bonus issue comes up will be, if I take the present value of dividends from years 1 to 4 and then from years 5 to 8. The dividends over here will be, let us say, well, there is one share of rupees 100 and the rate of dividend is 20%. So dividend is 20 per annum. However, this same one share will now become 1.25 shares. Remember, in bonus your face value remains the same, that is 100, but you now have 1.25 shares with a face value of rupees 100 into, let us say, 20%, and hence the dividend over here becomes 25. Okay, so we will try to find the present value. Maybe you can take the annuity factor at the rate of 10%, and considering that, you will try to get, let us say, some present value. Okay, after this, at the end of the 8th year, you are going to get sale proceeds on selling the share, which is 900, but 900 is on selling one share. At the end of the 8th year, you must be holding 1.25 shares. Remember, for the additional 0.25 shares, you have not made any additional investment, so that one share itself becomes 1.25 shares, and hence the amount that you will get is going to be 900 into 1.25 comes to around 1125. However, there are some incidental expenses at the rate of 10%, that is 112.5, and hence in your pocket you will get 1012.5. Okay, so this you will find at the present value factor at the rate of 10% for the 8th year, and that should ideally give you the present value of the future cash flows that you are expecting, considering the dividend, considering the sale proceeds, everything. So if we look at these numbers, maybe just look at the present valuation. This is 117.52 plus 472.33. So if I total all of these, I'll get around 589. So the maximum amount I should be willing to pay will be 589. What is the current market price? 500. If I go to purchase the share, will I just pay 500? No sir, I will pay 500 plus there would be 10% expenses on purchase, and hence I will end up paying 550. Okay, even if I end up paying 550, I will get, sir, you have already taken 10%. These are 10% expenses on selling. These are 10% expenses on purchasing. I'll have to consider both of them separately. They're two separate costs. And as a result, I'll compare 550 with 589 and decide that the share is worth buying. Even if I pay 550, this share is capable of giving me cash flows after considering everything worth 589 today, and hence the share is worth buying. But the question also says that at what maximum price? Achha, can I say 550 is the maximum price? No, that is 500 ka price plus 10% expenses. Your maximum price can be 589.86. Yeah, but if I agree to pay 589.86 as price, then on that I will have to pay purchase expenses. No, so that means if 100 is the price and 10 is the expenses, and 110 is the total amount that I am willing to pay. Now if 110 is equal to 589, then 100 is equal to how much? So if I do a cross multiplication, 589.86 divided by 110 into 100 will come to what? 536.24. 536.24. So over here, when you look at 536.24, that is a maximum price that we are willing to pay. Okay, so this is to be compared with 500, and you can decide that 500, which is before expenses, 536, which is also before expenses. On 536 you can pay 10%, it will become 589. So you can either compare 550 with 589, decide it is worth buying, or compare 500 with 536 and decide that it is worth buying. But the maximum purchase price will be the price of the share itself, which is around 536.24. Okay, fair enough. So these are the two questions regarding multi-stage valuation in case of Gordon's growth formula. Now a very important working which institute uses extensively in your valuation as well as in your mergers topic is free cash flow. Now why do you need to go to the free cash flow concept? See, valuation was currently done by Gordon based on dividend. Now the problem with dividend is discretionary, which means it is, some companies like Microsoft had not given dividend for 20-30 years. Dividend may not necessarily be distributed. So free cash flow concept says that you should value a company not based on the actual dividend it distributes, but based on the ability that it has to distribute dividend. So if it has generated what is called as a free cash flow, that is after meeting all its commitments, the capex commitments, working capital commitments, everything, if after meeting all the commitments, there's still cash which is available. Now whether it distributes or it does not distribute, it does not really matter. It has cash which is freely available, and hence valuation of a company should be done based on the free cash flows. Now free cash flows over here can be found for something called as a firm, that is an enterprise comprising of debt and equity both, or it can be done purely for equity, that will be based on equity only. Remember, like when you did your CA Inter, you calculated ROE which was only for equity, but there was an ROC, return on capital employed, which was based on debt and equity both. For ROC you looked at numbers like EBIT, that is before interest, whereas for ROE you looked at numbers after interest like PAT for example. So over here you have two concepts. One is a firm concept which is debt and equity both. How do you find the value of firm? Well, the value of equity, market value of equity plus the market value of debt will give you the market value of the firm, that is the company as a whole. based on which there are two types of cash flows. There is something called as free cash flow to the firm and free cash flow to the equity. How do you calculate free cash flow to equity? Well, we will start with PAT. PAT belongs to the equity shareholders. It is after interest, after tax, everything. So PAT, should PAT be the free cash flow? First of all, PAT is not a cash flow only. Forget free or not, it is not a cash flow only. So how do I convert PAT into a cash flow? Like you were used to do in your CA inter cash flow statement, you will take PAT, add back non-cash items like depreciation. You will say PAT plus depreciation. Will that be cash flow? Well, PAT plus depreciation, we have removed the non-cash items. However, there may be certain working capital changes if you remember. Increase in current assets you will deduct, increase in current liabilities you will add. So basically, if I want to find the cash flow from operations, I will adjust the working capital changes. So I will start with PAT, add back depreciation, and then add or less. Add or less. If it is increase in working capital, you will deduct. Decrease in working capital, you will add. Now this is similar to finding CFO, cash flow from operations. However, cash flow from operations, is that a free cash flow? No. If I want to grow, if I want to maintain my company, I have to invest some money in capex, capital expenditure, like buying increase in fixed assets. So if I'm spending money to buy fixed assets, less increase in fixed assets, this is sometimes called as capex, capital expenditure. Or add, decrease in net fixed assets. Let's say I'm not growing, I'm kind of liquidating, selling my fixed assets, that I get money, that is also added to my cash flow. So basically, after meeting this, ideally my cash flow should be free. Sir, free to do what? Well, to distribute as dividend to the shareholders. No, you have considered the operating expenses when you did PAT and everything. You have considered the investing commitments that are needed when I take increase in fixed assets, etc. But what about loan repayments? What if you have to repay a loan? In which case, I need to keep aside money to repay that loan, and only after that can I say that I have money which is freely available to distribute as dividend. So borrowings or preference shares to be repaid, but sometimes borrowings can be taken or preference shares can be issued in the years when they are actually taken. That is a cash flow for the company. For the equity, and hence we should add them. The logic of adding these over here is, when you have taken the fixed assets, you have taken the entire money which is spent for fixed assets. It is possible that out of 100 of fixed assets, 60 is using debt funds, 40 is using equity funds, but I have subtracted the entire 100 as capex over here. Out of this 100, if 60 is using debt funds, then plus 60, I might have taken a loan of 60, and hence net 40. So this will give me FCFE, free cash flow to the equity. Sir, I should also consider interest. Well, when I take PAT, interest is already deducted, principal payments are deducted at the end. So simplistically, FCFE is PAT plus non-cash expenses like depreciation, plus or minus working capital changes, plus or minus fixed capital change, fixed asset changes. Usually there is an increase in working capital which you deduct. There is an increase in fixed assets, also called as capex, that you kind of deduct. And less borrowings to be repaid, add borrowings to be taken, and this will give you FCFE. Now FCFE belongs to the equity, and hence if we want to find the value of equity, you will take FCFE divided by KE minus G. KE, because if it is cash flow for the equity, you discount it at the required rate of return for the equity, minus G to give you value of equity. Similarly, you will find, if you want to find the value of firm, well, to the value of equity, you will add the value of debt and preference shares if there are any, to get the value of the firm. Unless given otherwise, the market value of debt can be assumed to be similar to the book value unless it is given otherwise. Then you go to FCFF, free cash flow to the firm. When you look at the firm concept, firm is like capital employed, it is debt and equity both. Is PAT the pool of money available for debt and equity both? No, PAT is only for equity. PAT is EBIT minus interest minus tax. Remember, tax is paid to the government, that is not a provider of capital, but interest is paid to debt holders, who is in firm concept treated as a provider of capital. So when I want to find the pool of money available to the firm, that is providers of capital, that is debt and equity both, I need to take it something like EBIT, but EBIT is before interest, but it is before tax as well. So what I do is I will take PAT and to that add back interest, but if I am adding back interest, I will also add back the tax savings that I might get on that. So over here I will take PAT, add back interest into 1 minus t. I will add back the interest into 1 minus t, PAT, add back interest into 1 minus t. Okay, so that is like the pool of money for debt and equity both. Then again I'll do the same thing, add back depreciation, that is non-cash expenses, adjust the working capital changes if required, adjust the fixed asset investment if any. So basically it is usually an increase in working capital for a growing company. So I'll deduct the increase in working capital and I'll also deduct the increase in fixed assets, that is capex as a case may be. But what I will not do is adjust the borrowing taken or borrowing repaid, because now I don't have to worry and keep aside money separately saying that I can only distribute money after debt holders are paid. Well, debt holders, we are trying to find the pool of money which is available to pay the debt holders as well as equity holders, and hence we need to find a number before the borrowings repaid or borrowings taken. So that will give me the free cash flow to the firm. Here you will add back interest, but you will not adjust the borrowings taken or borrowings repaid. No, because they are to the providers of capital. It's like an appropriation. So the FCFF that I get will be discounted at what? Sir, WACC. Why? Because this is cash flow for debt and equity. Both you should discount it at the WACC minus G to find what? Sir, the value of the firm. So if I am taking FCFF, WACC, what I get is the value of firm. And value of firm equals the value of debt plus value of equity plus the value of preferentials. From this, if I want to find the value of equity, value of firm minus the value of minus the value of debt will give you the value of equity. If you want to find the value per share, divided by the number of shares, and that will give you the value per share. This is a traditional working that you have to do. Generally, in every such multi-stage free cash flow question, you will first see, based on the given data, that do you want to find the value as per FCFF approach or FCFE approach. Usually you look at the ingredients. If data regarding borrowings taken, borrowings repaid is available, then FCFE is possible. But if data regarding borrowings taken, received is not available, then FCFE is difficult. Then you will probably have to use FCFF. For FCFF, we typically need the data on interest. But even if interest is not there, now as long as EBIT is there, this number, that is PAT plus interest into 1 minus T, will always equal to EBIT into 1 minus T. You can even, if you have done EVA, you know that EVA, no PAT can be calculated as EBIT into 1 minus T or PAT plus interest into 1. It is one and the same. So even if I don't have the interest data, if I have EBIT, I can do directly into 1 minus T. If I can prove that to you, let's say EBIT is 100 minus, let's say interest is equal to 40, which means this is 60, 30% is the tax rate, let us say this is 18, and hence my PAT comes to what? I think 42. Using the first method, I'll say PAT plus 40 into 1 minus 0.3, which means this is what? 40 into 0.7, this is 42 plus 28, I think this comes to 70 rupees. Or I can take 100 into 1 minus 0.3, which will also come to 70. So this is another alternative way to kind of use these workings. Okay. Also for valuation, sometimes you might be given data regarding PAT and interest. You can use it. If you are given EBIT, then you can even use this for your FCFF working. For FCFA, you need WACC. For KE, you can, if there is only KE, you can calculate based on FCFE. Question should ideally guide you, but if not, you will have to kind of do some workings. Now there is also a shortcut possible. Okay, so the first step typically is to find whether you decide whether you want to solve using FCFF or FCFE based on the available data. Second is to calculate the discount rates if they are not available, like KE, KD, WACC, whatever is required, calculate the discount rates. Third step is to figure out the free cash flows during the 3-4 year period. If you need any working notes, like for depreciation, for capex, for working capital, whatever you need working notes, you prepare the working notes. Then you go to the terminal value, and then terminal value plus, let's say, the exponential growth period will give you the value. Now this may be the firm value if you have used FCFF, equity value if you have used FCFE. You also need to find what is, figure out what is asked. If you were asked to find value of equity and you have found value of firm, then you subtract that. If you are asked to find value of firm and you have found value of equity, add that. So again, quickly revising the 5 steps. Step number 1, figure out FCFF or FCFE approach based on the available data. Second, calculate KD, KE, WACC to the extent required. Third step, find the values during the exponential 3, 4, 5 year growth period. While doing so, in the third step, make all the necessary working notes if you don't have capex, working capital, etc. Step 4, find the terminal value, which is usually based on, let's say, if there were 5 years and then the growth stabilizes, D6 or free cash flow for the year 6 divided by, if it is free cash flow to equity divided by KE minus G, if it is free cash flow to the firm, WCC minus G, that will give you the value at the end of 5th year. Discount it. That is step number 4. And step number 5, you combine the two to find the total value. But you never end at step 5 blindly. You see that whether this is the value that I want. You might have got the firm value, you need the equity value, then subtract the value of debt. You want the equity value, but or you want the firm value, but you have got only the equity value, add the debt to find. So that is the 6th step, and usually the most of the complex questions that come from the equity section come from here, and these are the 5 steps that you need to follow. Okay, WACC as can be seen as cost of debt into weight of debt, cost of preference into weight of preference, into cost of equity into the weight of all of these. Now, an alternative shortcut is possible to calculate FCFE in case the debt ratio is given. Debt ratio is usually debt to the assets ratio. In case debt ratio is given, I say that, well, FCFE usually is PAT. Now, PAT purely belongs to equity and equity only. There is no attribution of debt, plus depreciation minus increase in working capital minus increase in fixed assets or capex. Now the thing is, fixed assets current year you might buy 100 rupees. Let's say you are a showroom company, you open a new car showroom of 100 rupees. Out of this 100 rupees, you are clear your target debt to asset ratio is 40%, which means out of 100, 40 will go from debt, the remaining 60 will go from equity. So we will say if I subtract entire 100 is not going to be funneled out of equity pocket. Only 60% of it will go from the equity pocket. So over here what you will do is you will take into 1 minus D. So you will say that, well, in all likelihood, if I will spend 100 behind capex, out of that 100, 40 rupees will come from debt, that is borrowings taken, the remaining 60 will come from equity. So rather than adding and subtracting the borrowings later, I will do a directly 1 minus D. Similarly, I may be a car showroom company, I will need money to buy the fixed assets. I will also need the money to buy the stock like the working capital. So this is 1 minus D even over here. Depreciation, remember, comes out of fixed assets. If fixed assets are financed out of debt and equity, even depreciation you do 1 minus D. So do I do 1 minus D on the PAT? No, I will not do that because PAT only belongs to the equity. So this is the adjustment that you do, but while you are doing it, remember you will not then separately adjust the borrowings again, because instead of separately adjusting the borrowings, you have directly done a 1 minus D adjustment in this particular case. Are we clear with this? Just a second, I think my iPad screen had frozen. So we are still on the same page, just that I had made some markings over here. You will do this 1 minus D adjustment in these particular cases where debt is a debt ratio, that is debt upon debt plus equity. This is in rare cases if such data is available. Okay, so based on that you have the free cash flow based questions. I think 2 or 3 questions over here. Let us try to review. Let us first go to question number 10. Question number 10. Institute has also asked a recent exam question on this. So let's review question number 10. It's a slightly complex question. Another important question on a similar lines is also there in the mergers chapter, something like this. Following information is given in respect of WXY, which is expected to grow at the rate of 20% per annum for the next 3 years. Okay, after which the growth rate will stabilize at 8% per annum level till perpetuity. So there will be 3 years, and after 3 years the growth rate is going to stabilize at 8%. Okay, we have revenues, COGS, operating expenses, capital expenditure, and depreciation, which is included in operating expenses. Okay, so if I go to see, this is for the year which has already ended, so this is past data. Revenue minus COGS minus operating expenses. This includes depreciation, so it is also after depreciation. This is 7,500 minus 3,000 minus 2250 will come to around 2250. This seems to be like EBIT, operating expenses, EBIT. During the high growth period, that is the first 3 years, revenue and EBIT will grow at 20%. Now if you remember CA inter leverages, when does revenue and EBIT grow at the same rate? Well, if there is no fixed cost, everything is variable, that is the only way, because if there is any fixed cost, if the revenue is growing at 20%, EBIT will grow at a number other than 20%. However, if EBIT is also growing at 20%, then every number in my COGS will also grow by 20%. Operating expenses, which include depreciation, will also grow by 20%. A lot of students rightly think that sir, depreciation will remain the same. Maybe it is growing. So how can it grow? Well, every year as you are growing, you might be buying new fixed assets, due to which there might be more depreciation as well. Whatever be the reason, if EBIT also grows at 20%, revenue also grows at 20%, in which case one can say that all expenses that go in the EBIT calculation are also growing at 20% per annum. And the capital expenditure, this is a very weird thing, okay, this is where students face a lot of problem. Capital expenditure net of depreciation will grow at 15%. Capex net of depreciation will grow at 15%. Now there are two ways in which you can solve. Both will give you the same ultimate answer, but there's a shortcut and there's a long cut. We will discuss both of them for your understanding. From the fourth year onwards, that is the normal growth period, revenues and EBIT again will grow at the rate of 8% and incremental capital expenditure will be offset by depreciation. Remember, capital expenditure is always incremental. Capital expenditure is always additional, will be offset by depreciation. During both the high growth and the normal growth period, net working capital requirement will be 25% of the revenues. Okay, the WACC is 15% and the corporate income tax rate is 30%. Well, there is no data regarding debt given, there is no data regarding interest given, and hence, well, WACC, this may be, for all you know, a fully equity funded company. In which case, to worry whether it is FCFF or FCFE is meaningless, because if it is fully equity funded, FCFF bolo, FCFE bolo is one and the same. Find the value of WXY, that is the entire enterprise, using free cash flow through the firm and WACC methodology. Now, how do you do that? So, in this particular case, first you figure out whether you have to use FCFF or FCFE. In this case, we will say that if it is fully equity funded, whether it is FCFE or FCFF, it is one and the same, there is no debt. Second, you find the discount rates. Are the discount rates already given to you? Yes, sir, it is already given to you as 15%. Third, you will take the free cash flows during the exponential growth period, that is year 1, 2 and 3. Now, in this particular case, you will have, I mean, you can sit and find the revenue in the printed solution. You might have seen this, but you can sit and find revenue growing at 20%. You have been told EBIT also grows at 20%. Now, you want to find PAT. So, can I directly take EBIT, sir? Why not? So, I will take EBIT. EBIT over here was in the first year, in year 0, as we found, was 2250. Revenue minus COGS minus operating expenses, there is 2250 plus 20%. So, this is plus 20% comes to 2700 plus another 20% comes to 32540 plus another 20% will come to 3888. Now, after that, do I need the fourth year? Well, yes, because my terminal value calculation will be based on the cash flows in the fourth year. So, this is going to grow at the rate of 8%, which is coming to 4199 approximately. Okay. Next, you will subtract interest, which is not there, and hence directly tax, which means what you get directly is PAT. So, over here, tax rate is given to you at the end at around 30%, and hence 2700 into 70%, which is 1890, 3240 into 70%, 2268, 3888 into 70%, 2722, and 4199 into 70%, 2939. So, probably these are the PATs that you will possibly get: 1890, 2268, 2172, 2939. Let us say this is the PAT. Now, ideally to this you will add back depreciation. There is some interest, but well, if there is no debt, interest adjustment is meaningless. I mean, there is no interest only. And you will subtract what is called as capex. Now, the thing is, I don't have depreciation of each of the years, I don't even have capex, but I have some relationship and I can find them. And then I will subtract the increase in working capital. Now, increase in working capital is relatively easier to find. We will say that we have been told that working capital is 25% of the revenue. So, if I can find the revenue, let us say for year 0, it was 7500 into 25%, if I am not wrong, 7500 into 25%, maybe 1875. Must be my existing working capital. Is that correct? 7500, last May you have been told 25%, correct. Now, if I go to year 1, 2, 3 and 4, my revenues will grow 7500 plus 20%, 9000 plus 20%, I think 10800 plus 20%, I think 12960, and then growing at the rate of 8% only, which is 13997. Okay, to this you will apply the 25% rate everywhere, and hence this is 9000 into 25% comes to 2250, which means there is an increase in the working capital by, I think, 2250 minus 1875, 375 rupees, 10,800 into 25%, 2,700, which means there is an increase of 450 over here. 12,960 into 25%, 3,240 minus 2,700, there is an increase of 540 over here, and 13,997 into 25% is 3,499 minus 3,240, that is around 259 over here. So this is fairly easy, where I will find 375, then this is all increase 450, 540 and 259. This is your net increase in working capital. Now comes the problem of, let us say, capex. So when I look at capital expenditure, I don't have the capex. Well, I don't even have the depreciation. However, I mean, I can honestly do it directly in my understanding. If I were to solve, I will do it directly, but some students want individual numbers. So first we will do the shortcut. They say that in capital expenditure net of depreciation will grow at 15%. Do I have the capital expenditure? Well, 750 net of depreciation, that is 600, that will come to 150. I am saying this will directly grow at the rate of 15%, and from year 4 onwards the capital expenditure will be offset by depreciation. So whatever is the capex will be offset by depreciation. Now I have to take plus depreciation minus capex. So if I was to look at the direct capex minus depreciation, that is my net capex. For year 0, this was 750 minus 600, which comes to 150. You are told that this 150 is growing at the rate of 15%, I think. So this is 172.5 when I go to year 1. So honestly, this is directly my capex. So some students make a mistake over here, take 150 minus 172.5. No. 150 is the actual additional capex done in year 1. 172.5 is the additional capex. If you are comfortable, you can directly take 172.5 direct subtraction. Some students say, no, sir, this becomes a problem. Okay, then you can find this. Sir, how will depreciation will grow at the rate of 20%? Why? If revenue goes by 20%, EBIT grows by 20%, then all the numbers that go in the EBIT calculation, COGS, operating expenses, depreciation will also grow by 20%. So 600 plus 20% will come to, I think, 720. Again plus 20% if you want to find will come to 864. Again plus 20% if you want to find is going to come, this is year 2, year 3, this is 1037 or 36.8, and going forward if revenue and EBIT both are growing at 8%, then depreciation will grow at the rate of 8%. This is 1120 approximately. Now if I were to find these capex numbers, I can easily do that. Well, this capex is growing by 15%, growing by 15%, growing by 15%. After that, what is happening? Well, the capex is equal to depreciation. They are getting offset, and hence the answer is 0. It is not growing by 8%, it is becoming 0, and hence my last year's capex will be 1120. 1120 of capex minus 1120 of depreciation, you get the answer. If I take the balancing figures in each of these years, x minus 720 is 172.5. So basically your x will equal to what? Probably 892.5. 892.5. Similarly, in the second year, x minus 864 equals, let's say, 172.5 plus 15% comes to, I think, 198.38. But this is unnecessarily long, I would say. You can directly take 228.13. You can directly take these numbers only, because that is the ultimate effects, capex net of depreciation. But if you want to show them separately, you can calculate each of these numbers like 864 and 198. You will get approximately 1062.38 of capex, 228 and 1037, and you will get around 1265. So if I take the full number, this is approximately, let's say, depreciation of 720, depreciation of 864, then 1037 and 1120. If I take the full numbers, this is also minus 1120, this is minus 892.5, minus, you can take 1062.38, minus you can take 1265.13. but basically if I actually do 720 and Oh, that's exactly 190, 172. If I take 864 and 1062, that is exactly 198. 1037 and 1265, that's exactly 228. So again, instead of showing both of them separately and spending so much time to find the depreciation, so last year what will we do? Well, answer will be 0. Whatever be the number, how do we care? Net impact is 0, and hence we can directly find the answer, in my opinion, in a much more faster way. But a lot of students prefer finding the depreciation, which you can, finding the capex, which you can. Otherwise, you can directly take the answers, and institute has also directly done that. So that is absolutely acceptable. So this will help you finding the free cash flows for the first 3 years, and then finding the free cash flow for the fourth year, which is, let's say, fourth is 2939, and if I do this working, this is around 2680. So if I want to find the valuation, I will take the present value of the cash flows. For example, for these years, maybe 1342, 1619, 1953, and then 2680 as we found. Now this 2680 will be used for terminal value. I can't assume that 1953 plus growth. It is not remaining the same. Capex is growing at a different amount. So some students, what they do a mistake is they forget the fourth year's column and they say, chalo, whatever is 1953 plus 8% will give you the fourth year's cash flow. That will give, provided every number, like PAT is growing by 8%, EBIT growing by 8%, Capex growing by 8%, that is not the case. Like you can see, depreciation and Capex are growing at some different tandem, and hence your answer will not grow at 8%. So in such cases, you have to manually calculate the fourth year's column and use that 2680 divided by KE or WACC minus 0.08, and you will get maybe around 38,000 something into 0.6575, that is a present value factor, and hence you will get 25,000. So basically the total of these two will give you the value of ABC, value of WXY. In this case, there is no debt, so firm value bolo, equity value bolo, it is one and the same. If there was a debt, then we would have adjusted if as required. Okay, so this is a slightly tricky problem. Question number 10, a similar problem came in one of the recent exams as well. Next is question number 9, which is also based on that shortcut. So calculate the value of the share from the following information. We have the profit after tax for the company, equity share capital of the company, and par value. So if I look at par value 1300, equity share capital divided by 40, which is the face value, so this will be 32.5. This will be 32.5 crores. Okay. Next is a very important piece of information. Debt ratio of the company is given. This was not given in other questions. So if this is given, a possible shortcut can also be applied. Long run growth rate of the company, that is G, beta is 0.1, risk free rate, that is RF, RM, capital expenditure per share, depreciation per share, change in working capital 3.45 per share. Okay, so if I want to find the value of the share, I can use FCFE, but for FCFE, sir, I need borrowings taken, borrowings repaid. No, I usually need that, but if I have the debt rate, I don't really need that, in which case I can find the FCFE, but for FCFE, PAT is for the entire company, not per share, but Capex, depreciation, working capital changes, all of them are given on per share. So you can either do all the workings on a per share basis, or you can do all the workings on a total basis. So if you want to find the value of a share, most of the data is given on per share basis, and PAT also you divide by 32.5, that gives you EPS, that is 290 divided by 32.5 comes to around 8.92. This will be your EPS. So this is, if I want to find the FCFE, I will say PAT 8.92. Think and tell me, will you adjust the debt ratio here? No. Plus non-cash expenses, that is depreciation, you will add back 39. Depreciation comes out of fixed assets, but fixed assets belong to debt and equity both, and hence into 1 minus 0.27. Further, some money spent behind Capex 47, again into 1 minus 0.27, because 47 is the total money spent behind fixed assets, out of which some money will come from debt, the remaining will come from equity. Whatever is the remaining amount is taken over here. Similarly, 3.45, it is a change assumed to be an increase because negative sign is not there, into 1 minus 0.27. And once you do that, you will get an FCFE per share. If you do all of this working, you will get around 0.56 per share. You can do the math and probably you get 0.56 per share. If the PAT etc. is for year 0, you assume this is for year 0. In which case, if I want to find the value per share, I will say FCFE1. This is FCFE per share for the next year divided by KE. Well, I don't have the KE. I can use that using CAPM 8.7 plus RM is 10.3 minus 8.7 into a beta factor of 0.1. Divided by whatever is the KE, you can find that minus the G. Long run growth rate is given to you as 8%, and that is about it. So you will take, I think, your KE coming up to 8.86%, apply all of this and get 70.33 per share. So this is also a type of a question that usually comes in your exam for relatively lesser marks. If a higher mark question would be asked, then something similar to question 10 can be asked. Lesser mark question, something similar to question 9 can possibly be asked. So that takes care briefly regarding this alternative formula as well and the free cash flow workings. Next, we have certain alternative valuation methods which are relatively less important, as we mentioned, from an exam perspective, and a few statistical models and workings as well. So we will review them. So we'll quickly discuss these relatively lesser important points in terms of alternative valuation if it lands up in the exam, and then we go to right shares, convertibles, money market, etc. So over here, these are alternatives. First, if you have earnings growth model, you take the same formula as the Gordon's formula, just that instead of D1, you will take E1 by KE minus G. That is the earnings growth model. Second is a P multiple approach, where you take the implied P. Remember, your actual P is the actual market price divided by earnings per share. However, another way to calculate, let us say, the P ratio is KE is equal to earnings divided by price. If I take the earnings in the denominator of the denominator, KE is equal to 1 divided by P by E. So that is a PE ratio, and hence the inverse of the P ratio gives you the KE, or if you kind of take it the other way around, 1 so P ratio can be equal to 1 divided by KE. So inverse of KE can also give you the P ratio. So you can take the EPS into the implied P, and implied P is calculated as the inverse of the KE. That is also another method which is possible. Now in both of these methods, there is only one problem which is there in the institute material. It has not really come in the exam, but in both of these methods, ICAI takes the actual return, that is R, to equal to the KE. Usually R is the actual rate of return, K is the minimum required rate of return. They may be equal, but they are not necessarily equal. But for these two methods, ICAI takes R equal to KE. So if it comes, you will do that only. Then there is another method called as the yield method, where the value per share is calculated by a simple cross multiplication on how much yield in percentage are you earning. Let's say you are earning 15% return upon the expected, that is the normal yield in the industry, which may be around 10%, which means for a share, if it is having a face value of 10 rupees, you can issue the share at 15 rupees because you are having a yield which is more than the industry. For every 1 rupee of face value or paid up value, you can command a premium. So that is like a cross multiplication where you might need to do certain adjustments if you are not directly comparable with that of the industry. Next, you have the Walters model, which is more of a model for the purpose of dividend valuation rather than anything else. So when you look at the Walters formula, it is price is equal to D plus R by KE into, let us say, the retained earnings into E minus D. So this is D plus upon the entire KE. So over here, the drawback of the Walters formula is that it does not contain growth or anything, and as a result, it is not a very popular formula to calculate, let us say, KE, calculate the price. But in case it is specifically asked to solve using Walters formula, well, you will solve as per Walters formula. Then there is a theory called as efficient market hypothesis. This was propagated by someone called as Eugene Farmer, who was trying to study the types of market in terms of the efficiency. So Eugene Farmer segregated the market into three types: weak form efficient, semi-strong form efficient, as well as strong form efficient. This may be important for theory perspective. So in terms of weak form efficient, the market structure is such that it incorporates movements due to past prices and volumes of shares. However, it does not contain information from publicly available sources or private sources. A much more efficient form of market would be a semi-strong form, which incorporates movements due to past price and volume, but along with that also considers the impact of publicly available information like an earning release or a press release or an annual report. Whatever information comes, that gets factored into the price. And the strong form is more of theory, it's like perfect competition, for example. So all information which is even publicly or privately available, the impact of that is incorporated into the price. In your exam, there may be questions, statistical ones, lesser chances of coming, but there may be two types of questions which can come for testing weak form of efficient market hypothesis. One where you test something called as autocorrelation. So first is autocorrelation and second is runs test. Now these are pure statistical problems. We'll do a quick discussion for the same. First, when you look at, let us say, something like autocorrelation means correlation with your own self. So generally when you test for autocorrelation, we will try to find a correlation of a stock with its own self. Like for example, if there's a time period of 20 days, you will segregate the first 10 days and the last 10 days separately. Assume they're two separate stocks. So return from the first 10 days and return for the next 10 days are compared as if one is stock X, one is stock Y, and you try to find a correlation. If the correlation is very high, close to +1 or close to -1, in which case the first 10 days movement is highly correlated with the next 10 days movement, in which case the market is not weak form efficient, it is inefficient. Why? Well, because if the correlation is close to +1, if the first 10 days are going up, the next 10 days are also going up. That is, you can predict. Or if the correlation is close to -1, if the first 10 days are going up, the next 10 days most likely will go down. How if the correlation is very close to 0, that is 0.1, -0.1, then the movements are random. So what you will do is, like you do in portfolio management, you will calculate the correlation. How do you calculate the correlation? If there's a 20-day time period, segregate into two data sets of 10 days and 10 days each, and then find a percentage return on a daily basis, assuming these are two separate stocks, and try to find a correlation, which can be done as covariance divided by the standard deviation of security X into standard deviation of security Y. You do it the way you do it in portfolio, and then interpret the auto correlation, that is correlation with your own self. Second is this runs test, which is also a very statistical thing if it kind of comes up, not very important from an exam perspective though, where you are given a data set. You will find N1, N2. N1 is the number of positive signs, that is price increases on a daily basis. N2 is number of negative signs, and R is the number of sign changes. Once you do that, you can use these formulas to find mu and standard deviation, and then based on a t-test, try to find a range at a lower limit and at a upper limit. If your R, that is the number of runs, are between that range, that means your movements are random. However, if your R is less than the lower limit or higher than the upper limit, then your movements are not random. Like for example, if the range is 4 to 15 and your runs, that is sign changes, are only 2 times, that means there are too few sign changes. People can easily predict what is going to happen with the stock. Or if your runs are more than 15, for example, and that means there are too many sign changes, I can know that if one day is positive, other day is negative, and so on. So that ways, this is regarding runs test and autocorrelation. You will have to separately sit and practice this if you want to get a grip on this from an exam perspective. If it comes, just apply those steps, get your marks, and proceed. Next, you have something on technical analysis, where there are various methods, various terms like support levels, resistance levels, those candlestick charts, where you are not looking at the fundamentals like growth, cash flow, etc. Instead, what you are looking at is certain chart related movements or volume related movements. This is technical analysis. There can be various techniques. Institute does not go into that from a numerical standpoint. However, there is one particular question called as exponential moving average, and Institute has tested you in the past and also in the recent past on calculation of an exponential moving average, and if it comes, you should be aware. We have also kept a sum in the important questions list for exponential moving average calculation. So over here there are 3 steps. First, you will figure out the exponent if that is not given. Usually if nothing is given, this is 2 up by n plus 1. N is the number of let us say days for which moving average is to be calculated. So if it's a 15-day moving average, 2 divided by 15 plus 1, that is 16. If it's a 30-day moving average, 2 divided by 30 plus 1, that is equal to 31, and so on. Once you find the exponent, then you find each day's exponential moving average as EMA of previous day plus or minus exponent adjustment. Now, how do you do the exponent adjustment? It is the difference between the today's date actual spot price minus the last day's average into the exponent factor. We'll do a sum on that, and the starting point over here can be the simple moving average of, let us say, the last 30 days or any other term as specifically given. Okay, we'll do a sum on that in some time, but before that, let us say if you look at another possible way of calculating the post issue market price, that can be the pre-issue market price plus the net issue proceeds. Let us say I have a company which with 1000 shares and price is 100 rupees, so 1000 into 100, that is a pre-issue market cap 1 lakh rupees, plus I am doing a fresh issue of 50,000, so that 50,000 will add to my total size of the business plus the issue proceeds. But what am I going to do with the 50,000 rupees? Let us say I am going to deploy this in projects which are going to give me a high return. So NPV on projects plus or minus NPV of bond repayment karte I will find the post merger market capitalization divided by the post merger number of shares to find the post issue or post merger market price per share. So there are sums 1, 1, 2, 2 sums on each of these concepts in general. However, from an exam perspective, these are more of miscellaneous concepts. If they come, you should broadly be aware. Institute likes asking you on this something called a sustainable growth rate. Now, sustainable growth rate calculation is nothing but G, which is equal to R into B. What does the word sustainable growth rate means? That even without taking any additional borrowings, how much can you grow? Well, if you don't take additional borrowings, then you have to grow through the retained earnings, and hence you look at your retention ratio, that is B, and multiply it by R to find, let us say, your sustainable growth rate. Okay, so it is more like a G is equal to R into B calculation. We will go to the next question over here, which is question number 11, which is more on exponential moving average. Let us quickly review this. The closing values of Nifty index from the 3rd to the 12th day of January 2022 are given below. So there are technically 8 days for which observations are given, where closing prices of Nifty is given. The simple moving average of the Nifty index for the month of December, that is, all of these are given for January. So for the last month, it was 17,174. So this can be taken as a starting point. You are required to calculate the value of exponent for 15 days EMA. Now this is calculated 2 divided by n plus 1. Now the mistake that students end up doing is they say, okay, 8 days are given, so we will take 8 plus 1. No, that is not correct. It is a 15-day EMA, and hence your answer will be 2 by 15 plus 1, that is 2 divided by 16, and hence this is equal to 2 divided by 16 comes to, let's say, 0.125. This is, let us say, 0.125, that is your value of exponent. Now the exponential moving average of the Nifty for the above period, calculations up to 2 decimals. So if we do it for 2 days, you will be able to do for the other days as well. So for example, you will start at the actual Nifty values. This is 17,626. From that you will subtract the average at the beginning. This is 17,174. So 17,626 minus 17,174. This is a difference of 452, and this 452 ka difference into the exponent factor, this is 0.125. So let's say the difference of these two, whatever that comes to, I don't have space over here, so this is, I think, 452 if I am not wrong, into the exponent, that is 0.125 into 0.125, that is 56.5. so that is going to give you the exponent adjustment, and hence you will say your opening moving average, which was 17,174 plus 56.5, 17,230. So the second day 17,230.5. So if I go to see over here, as you can see, 17,230.5. On the next day you will say that that becomes the opening 17,230. Well, I take the difference, 17,805 minus 17,230, 17,805 actual price minus 17,230.5 gives you a difference of 574. That into 0.125 will give you an exponent adjustment of 71. Now this 71 and this 17,230 plus 17,230.5 will give you 17,302.1. Now remember, if your exponential moving average keeps on going up and up, so as you can see, your moving average is going up, 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 and so on. This indicates a bullish market because the exponential moving average is going up. If it was going down, it indicates a bearish market. Sometimes a question may tell you that does it generate a buy or a sell signal? Analyze whether buy or sell signal is generated. The rule that you have to remember is, if your actual price line cuts the EMA from below, so let us say this is your EMA line, and if the actual price line, which is your actual Nifty line, cuts it from below, then at this point there is a buy signal if it cuts it from below. However, if your EMA, for example, is something like this, and your actual price line cuts the EMA line from above, at this point there is a sell signal. So in case a question asks you, analyze whether there is a buy or a sell signal. In this particular case, the EMA is almost always, your actual spot price almost always is higher as compared to EMA. If you sit and find, none of the days does the actual price of the Nifty cut the EMA. line like at 17,746, which is greater than 17,425, 17,813 greater. So it is always, so if I go to see over here, this is your price line, whereas this is, let us say, your EMA line. So till the time they don't intersect, a signal is not supposed to be generated, and as a result there is no signal over here. But since the prices are going up, maybe if I look at the trend, it seems to be a bullish trend. So this kind of takes care of the discussion regarding exponential moving average, that this has come in your exam as well. Now you go to the next part of valuation, which involves valuation in case of special cases like a right share or like a convertible or cases of buyback, for example. So when you are looking at special cases of valuation in case of rights, the valuation over here can involve something called as theoretical X rights price. You do this similarly even when you do your EPS workings. How do you calculate the X rights price or excluding rights price? Let's say the rights ratio is 1:4. The pre-rights market price is 150. The rights issue price is 100. You will find the weighted average price. You will say that, well, I need 4 shares of 150. Additionally, another 1 share of 100 rupees. And hence, if I look at the total, that is a total investment of 700 for 4 plus 1, that is equal to 5, and hence 700 divided by 5, that is 140 rupees, will give you the theoretical X rights price, excluding rights price. Next, you look at value of rights alone. How will you find the value of rights alone? Multiple methods are used, but usually we use the X rights price minus the rights issue price. So if we say that X rights price is 140 minus the rights issue price of 100, that means 40 will be the value of a right alone. So if I were to sell the right entitlement, I will expect to receive, let us say, 40 rupees on selling that right entitlement. Okay, that is one. Second is a case regarding buyback. In case of buyback, you might be asked to calculate the post buyback EPS. How do you calculate that? In the numerator, you will try to find the buyback, post buyback PAT. In the denominator, you will take the post buyback number of shares based on the available data and find the post buyback EPS. And post buyback market price is usually post buyback EPS into the post buyback PE will give you the post buyback market price. So based on the available data, you can try to find that. You have a question in your Super 90, which is a recent question for a buyback. So let us try to review that. So you look at question number 12. Now High Growth Limited was having an excellent growth over a number of years. The board of directors is considering a proposal to reward its shareholders by buying back 20% of shares at a premium. Okay. The premium is to be raised. Ideally, this is a printing mistake. The amount, I mean, they have used the word premium interchangeably, but this is the amount that you want to kind of spend on buyback is to be paid by raising a loan from a bank. The interest on the loan is to be serviced by internal accruals as supported by the financials. Okay. The company has a market capitalization of 15,000 crores and the current EPS is rupees 600 and a PE ratio is 25. So you have been given the market cap, you have been given EPS and a PE ratio. So you can find the market price, which is 600 into 25, and hence the market price is 15,000. Now, if the market cap is 15,000 crores, the number of shares pre the buyback will be 15,000 crores divided by 15,000 rupees, which comes to 1 crore. The board expects a post buyback market price per share to be rupees 10,000. Great. The PE ratio post the buyback will remain the same, that is 25. The loan can be availed at an interest rate of 16% per annum, that is giving you the rate of interest on the loan. The applicable corporate tax rate is 30%. You are required to calculate the interest amount which can be paid for availing the bank loan and the loan amount to be raised and the buyback amount per share or the buyback premium per share, let us say. So when I look at currently, your EPS is equal to 600 into 1 crore shares, and hence your PAT will be 600 crores. So if I look at PAT, this must be calculated, let us say pre the buyback. There must be some EBT which is the same as EBIT. Why? Because there must be no interest unless otherwise given over here, minus, if I look at the tax, let's say tax is at the rate of 30%, and hence this will give you PAT. So if my PAT pre the buyback was 600, well, if this is 100, this is 30, then this will be 70. So if 600 is 70, then 100 is how much? Well, probably 857.14. So pre-buyback, your earnings before tax would be 857.14. Now post-buyback, how much would that be? Well, you have been told that the market price post-buyback will be 10,000 and the PE ratio will remain the same. So if I look at the market price post the buyback, and have you been told how much Are you going to buy back? Well, by buying back 20% shares at a premium. So if you had 1 crore shares, 20%, that is 0.2 crores will be bought back, and hence remaining 0.8 crores will still remain. So post buyback, if I look at the post buyback market price, that is 10,000 divided by the post buyback PE, which is 25. So 10,000 divided by 25 will come to around 400. This will be your post buyback EPS. However, if I multiply it by the number of shares, there will be 0.8 crore shares post the buyback, and hence there will be 320 will be your post buyback situation. So in my post buyback setup, what will happen is, I would say that, well, there will be 400 into 0.8. Post 400 is a post buyback EPS, 0.8 crores is a post buyback number of shares, and hence this is 400 into 0.8 comes to 320. Again, there will be tax, so this is equal to 70. Then 100 is equal to how much? Well, this comes to around 457. This comes to around, if I'm not wrong, 457.14. Now earlier this was 857.14. Now it is 457.14. What is the difference? Well, if the business remains the same, the difference is due to probably interest. So there seems to be 400 crores of interest. So interest amount which can be calculated, maybe it is 400. So if I go to see the working over here, it seems to be 400 crores of interest. Now the rate of interest is 16%. So if 400 divided by 0.16 I do, that is 2,500 will be the value of the loan. So this is the loan amount to be raised. And last, they are asking you the buyback premium per share. Now what the ICAI has done is, they have compared your buyback price with the post buyback price. One can also compare it with the pre buyback price. However, what will be the buyback price? Well, if I am spending 2,500 crores to buy back 0.2 crore, which means 2,500 divided by 0.2 comes to 12,500 must be the price that I am paying for each share. So this is the market price of 12,500. However, the market price after buyback is 10,000, and hence the buyback as per ICAI, and I would beg to differ over here, but yes, there can be an alternative interpretation, but nevertheless, as per ICAI, the buyback premium is the premium of the buyback price over the, in this case they have considered to be the post buyback price. One can also review it vis-a-vis the pre-buyback price, but nevertheless the premium over here is treated as your buyback price is 12,500 when the post buyback price is likely to be 10,000, and hence 2,500 is treated to be the premium which is arising due to the buyback. Okay, so that takes care of your buyback. Next, you have this section of warrants, which I would say is not very important. In fact, it is not even there in the institute material. How do you find the value of a warrant, or what is warrant period? Warrant is nothing but like an option. So to understand warrant better, we will go to convertibles, and convertibles are something which is important, and in today's world with MCQs, this assume a lot of importance, because you can easily be asked even an MCQ or a descriptive question on these specific terms, and you can have a 1-1, 2-2 mark question. So there are a lot of terms. We will just try to discuss what each of these terms mean. Having said that, the best way to understand this is with the numerical. So let's try to dive into the terms and then go to a sum on these convertibles, which can give you a better understanding. So let us look at those terms. First, there is something called as conversion value, also called as stock value. This means that the value that you will get if the bonds were to be converted into equity shares today. Usually we calculate it as the number of shares per each bond into the market price of the share. That will give you the conversion value. Second is conversion premium. Acha, conversion premium we will calculate, just a second. Conversion premium is the premium, that is the difference between the market price minus the conversion value. So market price of the bond minus conversion value. This can be asked in percentage. Then you divide it by the conversion value into 100. It can be asked as a ratio. It can be asked on a per share basis, and you divide by share, various terms. Conversion premium is the market price of the bond minus the conversion value. A similar term over here is the straight value. Straight value is if the bond continues straight, that is as it is, then what will be the value? That is, had there been no conversion features, then the value of the bond is the present value of future interest and principal payments. That is a simple valuation of bond. If the conversion option is not exercised, what will be the value of the bond? A question can also ask you to calculate something called as premium over straight value. That is again the market price of the bond minus the straight value. That is called as premium over straight value. Okay. Next, you have something called as downside risk. Downside risk is another term for premium over straight value only. What does it mean? That what does the bond what downside does the bond have? Well, if the equity conversion feature becomes useless, still the bond will come down to the straight value, and hence the market price of the bond minus the straight value will be called as uh, the downside risk that the bond carries. Next, we have conversion parity price, also called as the market conversion price. This is the effective price that you are going to pay for one share if you were to buy it through the bond. So over here you will take the market price of the convertible bond divided by the number of equity shares per bond. That is the effective price that you will pay for each equity share. Conversion parity price. Income differential can be favorable or it can be adverse. Income differential is the interest income that I will get on the convertible bond minus the dividend income on equivalent number of shares. If the interest income of the bond is 100 and the shares is, let us say, 70, that means 30 is the extra income that I am getting on a per bond basis. This is favorable income differential. The question can also ask you to calculate a payback period, premium payback period. Remember, you are paying an extra amount to get the bond, so that is a conversion premium. And for that you are also getting some extra income. Let's say in our example 30 rupees in each year. So if the premium was 300 and you are getting an income of 30 each year, then the payback period is approximately 10 years. Okay, so there are a few questions based on that. We will take one of them, that is question number 13, which is based on application of these concepts. Let us quickly try to review this. The following data is relating to 8.5% fully convertible debentures issued by JSC Limited at 1000 rupees. Market price of the debenture is 900. Conversion ratio is 30. So one bond becomes 30 equity shares. Straight value of the debenture is given to you as 700. Market price of the equity share on the date of conversion is 25. And expected dividend per share is 1 rupee. What is asked? First is conversion value. So if one bond were to convert, it will convert into 30 shares and each share is worth 25 rupees, and hence this is probably 750. This is called as the conversion value. Second, you will have market conversion price. That is, if I were to go in the market and buy the bond, it will cost me 900 and this bond will give me 30 shares. So effectively 900 divided by 30, that is equal to 30 rupees per share is the conversion parity price, or also called as the market conversion price. Conversion premium, but on a per share basis. Well, I will say that the market price of the bond is 900 minus the conversion value is, let us say, 750, which means 150 is the premium per bond, but one bond gives me 30 shares and hence 5 rupees is the conversion premium on a per share basis. Ratio of conversion premium, this will be conversion premium, that is again 900 minus 750 upon 750, that is probably 1:5, or let us say 150, that is 0.2:1 will be your ratio of conversion premium. Premium over straight value, this can also be called as downside risk, will be 900. In the worst case, the bond will fall down to the straight value, that is 700, and hence the premium over straight value is, let us say, 200. And the favorable income differential, again on a per share basis. So if I look at income differential on one bond which has a face value of 1000, I will get a coupon of 8.5% and hence each year I will get 85 rupees as income. Instead, if I were to convert it into shares, I will get 30 shares and the expected dividend per share is 1 rupee. And as a result, if I go to see 85 minus 30, that is the 55 rupees is the favorable income, that is the extra income I were to get in case of, let us say, a bond. However, this is per bond. One bond will give me 30 shares and hence 55 divided by 30 comes to, I think, 1.833 extra. That is a favorable income differential on a per share basis. And there is a premium payback period. Just a second. Premium payback period can be done on a per bond basis or a per share basis. I will say that I am actually paying a 150 rupees premium for each bond, and in return I am each year getting 55 rupees more. So 150 divided by 55 comes to around 2.72 or 73 years will be the premium payback period. So this is a fairly interesting question. I would want you to practice this for a better understanding of your convertibles. Different terms can come. On the face of it, these terms may sound to be intimidating. Remembering these formulas may be even difficult, but if you understand these terms, you can actually devise a formula on your own quite easily. Okay, that takes care of convertibles. The last part over here, okay, there can also be warrants. Warrants is the same thing. If you want to find the price of the warrant, that is nothing but the market price of the equity share minus the exercise price. So if your equity share is worth 80, exercise price is 50, then for each warrant, I should pay 30 rupees. However, if the warrant premium is the market price, let's say the warrant is running at 35 rupees in the market, minus 30 should be the value. So 5 rupees is the extra premium that you are having over the warrant. It is the same case. So instead of a convertible bond, you might be asked regarding warrants or options as well. Okay, the last part of this chapter involves money market instruments. Now, Institute earlier did not ask you sums per se on this, but over the last 2 years, they have introduced this into the study material. Still, no notable sums have come in your main exam, but just in case they come, you should be aware of. So, what do you mean by money market instruments? These are instruments where you are investing in very short term, which means less than 1 year. So over here, the features of this instrument is it's a very short term instrument, less than a year typically. Participants over here like banks, authorized dealers, financial institutions, etc. And the volume over here is quite large. Various types of instruments that are there depending on who is the issuer. Like in government, treasury bills, usually the issuer is the government, or in case of corporates, highly rated corporates, commercial paper. Issuer is like a corporate, like a Reliance or a Tata for example, or a certificate of deposit where the issuer is a bank like HDFC Bank, SBI, etc. So when I look at this, treasury bills, commercial paper as well as certificate of deposit, they are almost the same thing. They are like bills of exchange which are issued either by the government for treasury bills. For commercial paper, it is a corporate, or certificate of deposit, it is like the bank. And they are raising money for a short term tenure, maybe less than a year in all cases. Next, you have something like call or notice money. This is very short term money. If you are raising money for a period of around less than, let's say, 14 days, maybe you need money to pay GST or advance tax, that is what we call as call or notice money for a very short term duration. And last, there is repo or reverse repo, for which the institute has asked a fairly complex type of a question. So we will review that on what is repo. Is a repurchase agreement where I will sell a bond and agree to repurchase it at a predetermined price at a specified date, that is in order to compensate the lender for the interest. Almost every money market instrument is issued at a discount, and hence if you want to find the annualized return, also called as the bond equivalent yield, in simple interest terms, you will do it as F minus P upon P. So let us say you are issuing a bond at 97.5, face value is 100. So this is 100 minus 97.5, you are getting only 97.5 today, into 100. This will give you the cost. However, this is the cost for the tenure. Let us say the tenure is only 91 days. So on a per annum basis, it will be how much? This is for 91 days. So on a per annum basis, it will be how much? This will give you the annualized return or bond equivalent return. So this is usually the formula for this. You can do it in months or days depending on how the questions. If the question gives you the tenure in days, you do it in days. If the question gives you tenure in months, you will do it in months. Now, sometimes they might ask you to calculate effective return. Remember over here, if the term is around 91 days, that is around 3 months, we will say that actually, if I am an investor, if I invest 97.5 today, I will get 100 after 3 months. I will again invest 100 rupees, get maybe 103, invest 103. So there may be some compounding effects, and hence if I have to find the effective return, I will take 1 plus the bond equivalent yield. Sir, why is it called as bond equivalent yield? Because bond yield is typically given in a per annum basis, divided by, let us say it is a 3-month instrument. So if your annualized return came to, let us say, for example, 12%. So this is divided by 12. So this is 3% for each quarter, and there are 4 such quarters, minus 1. So this will give you 1 plus the annualized yield upon M. M is the frequency in a year, into 1 by M. So this is regarding these typical questions. We will try a question on these lines, question number 14 or rather 15, and then come to the repo, reverse repo type of a question. This might now in today's environment come like an MCQ. From the following particulars, calculate the effective rate of interest. For effective rate of interest, you will have to first find the bond equivalent yield or annualized rate of return, and then try to see for compounding, as well as the total cost of funds to Bhaskar Limited, which is planning a commercial paper issue. Issue price is 97,550, face value is 1 lakh. So this is 1 lakh minus 97,550 upon 97,550 into 100. But this is not per annum return. If I want to find a per annum return, into 12 divided by 3, and hence this is what, 1 lakh minus 97,550 upon 97,550 into 100 into 12 by 3, which is, let's say, 10.046%. Is that the effective rate of return? No, this is the annualized return, or also called as bond equivalent yield. You want to find the effective rate of interest. So for effective rate of interest, you will say 1 plus 0.10046. This is a return for 12 months. I am saying that the return is going to be compounded every 3 months. That is 4 times during the year. So this is divided by 4. So in 1 year there are 4 quarters, raised to 4 minus 1. So this is 0.10046 divided by 4 plus 1. You get 1.025115 raised to 2, 3, 4. This comes to approximately 1.1043 minus 1, that is 10.43% per annum effectively. However, this is the effective rate of interest, 10.43% per annum. This is after considering the effects of compounding. Issue expenses include brokerage, 0.15% for 3 months, rating charges 0.5%, but this is per annum. Stamp duty 0.175%, let us say for 3 months. So if I want to find the total cost of funds on my effective cost of 10.43%, let us say, which is per annum, brokerage, I can't just add 0.15%. Now that is for 3 months. That means if I want to do it on a per annum basis, this will be what? 0.15% into 12 by 3, that is around 0.6% on a per annum basis. Rating charges are already given on a per annum basis, so I will not make any adjustment. And stamp duty again 0.175, and this is, I think, 0.7% on a per annum basis, and hence 0.7, 0.6 plus 0.5 and 10.43 comes to around 10.43 plus, let's say, 12.23% per annum in case total cost of funds are asked. Okay, so this is question number 15. Next, you have this transaction regarding repo and reverse repo. Now, over here, what is happening is there is going to be a sale of a bond for which you are going to get some proceeds. Now, these proceeds, how do you determine these proceeds? Well, if there is a bond of 100 rupees, face value, market price is 110. What I am giving you is worth 110. You might say that, okay, against this I will give you a loan, but I might say that I will keep 20%, let us say, as margin. So 110 minus 20%, I will give you only a loan worth 88 rupees. On that 88 rupees, you agree to give me my money back after, let's say, 25 days. I will charge you a specified rate of interest for those 25 days. And that will be my repurchase price. My repurchase price is the loan that is given plus the interest agreed on that loan for the specified period. Over here, sometimes you might be given the price of a bond as an ex-interest price of the bond. However, the true value of the bond that I will get if I were to sell it in the market is not just the ex-interest price, it is ex-interest price plus the accrued interest on the bond, which is the cum interest price. In the context of repo and reverse repo, this is called as the clean price and the dirty price. Clean price is similar to the ex-interest price, dirty price is similar to the cum interest price. So over here, we will say that if the bond is worth 110 ex-interest, after considering accrued interest, it is worth 110 plus 5, that is 115. So what I am giving you is worth 115. You are telling me that I have a security worth 115. That does not mean I have to give you the loan worth entire 115. 115 minus, let us say, 20%. This will come to, let's say, 92 will be what I give you. On 92 will be the interest which is agreed under the repo transactions, and that will give me the amount to be paid in total. So keeping all of these factors into consideration, if I review question number 14, Bank A enters into a repo for 14 days. So the repo term, remember, is 14 days with Bank B in 10% Government of India bonds 2028. So what is happening is Bank A is going to give a GOI 2020-28 bond to Bank B, and in return Bank B will give me something. This is like the loan at 5.65% for 8 crores. Assume that the clean price, that is a price that does not have accrued interest, also called as ex-interest price, will be 99.42 and initial margin is 2%, and the days of accrued interest will be 262 days. you are required to determine the dirty price and repayment at maturity. Consider 360 days in a year. We can add a couple of things over here. We can say that the face value, let us say per bond, let us say institute has implicitly assumed it, we are explicitly assuming to be rupees 100, and number of bonds. Well, rupees 8 crores hai and 100 is the face value, so number of bonds is equal to 8 crores divided by 100 comes to 0.08 crores. 0.08 crores, or let us say 8 lakhs. Just keep that into consideration. Now the first part is they are asking you to find the dirty price. So the dirty price is the cum interest price. How will you do that? Well, you will take 99.42. This is the ex interest price, plus you will add the accrued interest on the bond, whether there is repo or there is no repo. You will say this bond has a face value of 100 into the rate of interest on this bond is 10%. Now there are two rates. One is 10%, one is 5.65%. 5.65% is the repo. However, on this bond, there is a 10% interest which is accrued for 262 days out of 360 days as is required. So, 100 into, let us say 10% into 262 divided by 360 comes to what? 7.28. This is 7.27 or 28 as a case may be, and hence if I take 99.42 plus 7.28, which comes to 106.7. This will be my cum interest, or also called as dirty price. So this will be 106.7. It includes the accrued interest as well and the repayment at maturity. Now for each bond, let us say they are agreeing to give how much? Well, 106.7 minus 2%. Minus 2%, that comes to around 104.566 or 57. This is per bond into 0.08 crore bonds. Into 0.08 crore bonds. So probably this is 8.36528, which B is giving to A for 14 days, after which A is going to give back some money along with 5.65% interest, and then we will give back the bonds. So at repayment, how much will be the amount to be paid at repayment? We will say that, well, 8.63528, for example, on which there would be interest at the rate of, you guys tell me, this is 36528. This is rate of interest at what rate? Sir, this will be 5.65% into what period? 14 by 360. So over here, this into 5.65%, which is our repo agreement, into 14. Is it 14 days? Yes, divided by 360 will come to around, this is 8.36528 plus 0.01838 approximately, and hence this is 8.38366 crores. 8.38366 crores. The two important things 8.3836. The two important things over here to figure out is, for calculating dirty price, we will take what? Well, for dirty price, we will take the 10% rate and we will take the 262 days. Why? Because this is for the bond, whereas for repayment at maturity, this is for the repo, for which we will take the 5.65% rate and the 14 days tenure in order to calculate the repayment price. So this is, you will first find the amount of loan to be given, and once that is done, at the rate of 14%, sorry, at the rate of 5.65% for 14 days will help you in calculating the repayment price. So this kind of takes care of question number 14 as well. 15 we have already done, and this kind of takes care of the concepts and important questions from this chapter. Also practice questions regarding sustainable growth rate, where G is equal to R into B, and hopefully valuation of equity shares as well as valuation of bonds through an earlier video should kind of secure this chapter, one of the most important chapters for your syllabus. Okay, so that should be it for today. Thank you very much. I hope you enjoyed the video. Do like and share if you thought this video was helpful, and if you have not subscribed, please do press the subscribe button, and I'll see you soon with more videos. Till then, goodbye, good luck, and keep studying hard. Take care.